if you step back and you look at the markets in general, if you go back 12 or 13 months in March of 2020, the Dow was basically 19,000 and change, and the S&P was around 2,100. So in 13 and a half months, or almost 14 months, both averages have almost doubled in 13 and a half months. Think about that. Think about that. So you're going to get markets that simply get overbought, technically overbought, and we're all a little spoiled. Everybody is spoiled because the markets have been, relatively speaking, not all stocks, but relatively speaking, a rising tide has floated a lot of ships, and nothing goes straight up. Now there are reasons that trigger the sell-offs, but uh, but fundamentally nothing has really changed, and so therefore, when we get these downdrafts, until something really fundamentally changes. Now, what would that be? It could be interest rates, could be the inflation. There are certainly things to be nervous about and worry about, but I think that these pullbacks are just part of markets. It happens, but I think the markets are fine. I don't think the weakness we saw earlier in the week is disturbing or a reason to basically get nervous or scared. It's just part of the process, and you got to take the bad with the good. We have two schools of thought here. Number one, we have the Fed, and we are all taught in the world of finance never to fight the Fed. And number two, we have what, let's call it Mr. Market, the stock market. In my opinion, having now been in this business for almost 60 years, Mr. Market never lies. The market never lies. The market always somehow knows. The market, in my opinion, always tells the truth. The Fed, of course, is still the Fed, and they are the 800-pound gorilla. But I think that they send a message which sometimes is wrapped in politics, and Mr. Market doesn't send a message that's wrapped in politics. My guess, and it's just a guess, my guess is that the Fed perhaps is overplaying its hand here a little bit. I think inflation is a problem. We see it all around us. Commodities going through the roof, soft commodities, hard commodities. Procter and Gamble a couple of weeks ago said they're going to start to raise prices. So we see inflation everywhere. The Fed, of course, is telling us that there is no inflation, or that they want to. I'm not quite sure what the inflation message is from the Fed, but the reality is, where we all shop and how we live our lives, clearly we are all being subjected to inflation, if not a lot of inflation. The Fed dropped interest rates to zero because of the pandemic, COVID, right? And that was just 13 months ago. And it was the right thing to do, and there has been a lot of financial stimulation, the right thing to do. But as the vaccines become more readily available and the world begins to emerge from this COVID-19 cocoon and get back to normal, you have the Fed on the one hand telling us that they're going to keep interest rates at zero, perhaps to 2023. And on the other hand, we have inflation and the world's economy is waking up, if you will, coming out of the pandemic cocoon. I think the Fed is just kind of trapped. And so the answer to your question is they might do it very subtly, but I think at some point they're going to have to think about interest rates and basically being less accommodative, which potentially will be a negative for the market, because once again, we're all spoiled. In a zero interest rate environment with a lot of liquidity, and the world is awash in liquidity, saving rates at all-time high for many people, credit card debt going down. There aren't too many logical places for people to go in that environment One of them would be the stock market. But if that dynamic starts to change, then clearly that potentially is a negative for the market. But so I said, listen, we got to pay attention to the Fed, but I'd be inclined to pay more attention to the stock market. As the overall economy shows pockets of strength and overall strength, what we've seen is more interest in more of the value stocks, more the chemical companies, some of the travel companies, a lot of the sectors that basically were under so much pressure because of COVID are now beginning to emerge. And so it's not that the tech sectors are not good value here. What really is going on is that a lot of the money flows have gone into other sectors that lagged all last year. And we've seen that in our portfolios where we manage money for folks, and we tend to be more, less tech oriented and more focused on basic industries, the chemical stocks, and all these stocks that I mentioned we happen to own or we own for clients, like DuPont, for a chemical company, which has done well. These are stocks that aren't very exciting. The fact that the tech stocks in general, even though they're better today, if you go back to January, February, they have for the most part underperformed. Look at Apple, for example, which is a widely held stock. Apple had great earnings in the first quarter, but the stock really didn't do anything. So what's the message? And to me, the message is that Apple is a great company and the earnings were terrific, but perhaps the stock is pretty much priced to perfection. But I think there are so many other areas of the market that I find interesting or more interesting other than tech.